Most investors look at returns the same way. If two investments show 10% performance, they assume that they've earned the same performance. But the truth is that a 10% return can mean very different outcomes depending on how that return is generated and how it is taxed. I'm your host, Eli Freeman, a certified financial planner, and this is Data Brief, where we break down the data behind investing so that you can make better decisions based on facts and not feelings. As always, let's look at the data. A 10% return from price appreciation is not the same as a 10% return from income. The easiest way to think about this is if you bought a rental property, the rent that someone pays you is the income, and the appreciation is the house going up in value. The tax code taxes these differently. The type of return that you earn determines the type of tax that you pay. For some investments, that 10% is mostly yours to keep. For others, a meaningful portion goes to taxes before it ever reaches your pocket. For example, take a Yield Max ETF as an example. The Yield Max ticker YMAG has a 55.63% yield, which is worth a video completely on its own. These funds generate much of their return through option income, and option income is taxed as ordinary income. So, if you are in a 22% federal tax bracket, your 10% yield is really not a 10% return. After paying ordinary income tax, your actual after-tax return is roughly 7.8%. And if you're in a higher tax bracket, that gap widens even more. This also does not include state tax, which can be a major factor depending on where you live. Now, let's compare that same 10% return with Berkshire Hathaway, which, if you're curious about one of the most successful companies in all of history, Berkshire, I actually did an entire video on them, which I will link here. Berkshire pays no dividend, so your entire return comes from price appreciation. You do not owe tax as you go, but you owe it when you eventually sell it. And when you do, it's taxed as long-term capital gains, if you've held on to it for longer than a year. For most investors, that is 15%, but it starts out at 0%, and the highest capital gains, if you make over $600,000, is 20%. So a 10% tax-deferred gain comes out to about 8.5% after a 15% tax. That's a very different outcome than 7.8%, almost a 10% higher after-tax return. Both investments in this example earned 10%, but their after-tax returns differed meaningfully. One is taxed every single year at income rates, and the other is deferred, chosen when to pay the tax, and at a lower rate. The other benefit to the investment in Berkshire is that you can choose when you sell and pay the tax, whereas most income-producing assets produce income every single year, and that creates a taxable event every single year. Dividends add another layer. Investors often see a yield number and assume that it's all treated the same, and it's just not right. There are qualified dividends and non-qualified dividends. Qualified dividends are paid by most U.S. companies and many of the foreign companies that meet IRS holding period rules, which you can always just Google if you're confused. They are taxed at long-term capital gains rates, which are generally lower than your income rates. Non-qualified dividends include REIT distributions, bond fund interest, and money market income. CDs are also in this category. These are all taxed at ordinary income rates. So, if two funds both show a 3% dividend yield, but one pays a qualified dividend and the other does not, the after-tax return can be very different. A 3% non-qualified dividend becomes about 2.34% after a 22% income tax. Again, that's almost a 10% after-tax return difference. Over years, that difference compounds. Bonds work the same way. Corporate bond interest is always taxed at ordinary income rates, where you pay federal and state tax. Treasury bond interest is also taxed as ordinary income for federal taxes, but it is exempt from state and local taxes, which matters for investors in higher tax states. Municipal bonds are the opposite. Their interest is generally exempt from federal taxes and sometimes state taxes as well if it's an in-state municipal. That means that a 4% municipal bond may deliver a higher after-tax return than a 5 or 6% corporate bond, depending on your brackets. For an example, I plugged into a yield calculator if someone was to live in California and earn a 4% yield on a corporate bond. This individual makes $250,000 and is married. Their tax equivalent yield on a municipal bond is 2.67%. And on a Treasury, it's 3.51%. So after taxes, a 2.67% in-state municipal bond was actually worth a 4% yield on a corporate bond. And this varies by state, as you'd imagine. I live in Arkansas, so I also plugged in the same Fidelity calculator, all of the same inputs, but changed the state now to Arkansas. The same tax equivalent yield of a 4% corporate bond is now 2.88% for an in-state municipal and 3.79% for a Treasury. Clear as mud, right? This is why comparing returns without considering taxes can be misleading. 10% earned through income, options, and non-qualified dividends or corporate bond interest can shrink quickly after taxes, as you've seen throughout this video. 10% earned through qualified dividends, price appreciation, or municipal bond income often leaves more money in your pocket to compound year after year. The point is not that one type of return is always better than another, and I never want to confuse the fact that a phenomenal tax inefficient investment will always beat a bad tax efficient investment. The point is that returns are not created equal. Before judging an investment solely on its performance number, understand what kind of return it produces and how that return is taxed to you. Because when you look at the data, the difference between 10% on paper and 10% in your pocket can be substantial. I'm Eli Freeman, and this is the Data Brief. If you found this information helpful, consider subscribing because I put one of these videos out every few weeks, and I hope they're helpful for you.